Thank you very much for being with us here today, Vinny. All the attendees, I just ask that if you would please type into the chat box. I will be monitoring all of the questions. So if you have a question, please feel free to type that in. I will bring this up to Vinny as we go along, but without any further ado, let me just minimize that. Okay, great. So today we're going to be covering multifamily investing with our guest, Vinney Chopra. There we go. My name is Alex Perney. I'm a development specialist here at Advanta IRA. I've been with Advanta since 2012. If you have any questions, feel free to give me a call. I am always happy to answer any questions you have regarding self-directed IRAs or in the generalities of real estate investing with qualified plans. It's been a pleasure to be doing this for so long, and I really do enjoy getting to help people. A bit of a disclaimer before we get really into things. Advanta IRA and our employees, we do not provide investment advice, nor do we endorse any investment products. All informational materials are provided for educational purposes only, and all parties are encouraged to consult with their attorneys, accountants, and financial advisors before entering into any type of investment arrangement. A little bit about us here at Advanta. If you're coming to us through Vinny's network, we are a IRA custodian with over 20 years of industry experience. We have a dedicated staff of certified IRA services professionals. All of the assets that we hold, any cash, is fully FDIC insured, and every single individual client here that we're really proud to offer a very localized and specialized service model that allows us to have dedicated account management for every single one of our Advanta clients. And currently, we manage just over $1.3 billion worth of assets for our clients. So we have a good amount of experience and quite a few of these types of investments under custody to base our investment experience on. And that's why we like to have people such as Vinny on our platform. And by virtue of the fact today you are attending one of our live webinar events, we're very happy to be able to put on such a wide variety of great guests for you. This will be cataloged and put up on our YouTube channel. If you'd like to check out our Advanta IRA On Demand video library, please do feel free to go through that. This will be up here probably mid-afternoon tomorrow. So if you can't stay for the entire thing, or if you would like just to reference back to it, please feel free to go directly back to our video library. And if anyone would like a handout of the slides today, please note that they are uploaded in PDF format, so you can download them directly through this portal. So please feel free to do that as well. Now I'm about to hand it over to Vinny. A little bit about Vinny. Vinney Chopra is a real estate investor, syndicator, international best-selling author, and host of 4 podcasts, a multifamily educator, mentor, dedicated husband of over 40 years, father of 2 children, Neil and Monica, and he resides in Danville, California, in the San Francisco Bay Area for about 40 years. Vinny came to this country with only $7 in his pocket and a dream. Vinny has now built a portfolio of over 4,500 units, amounting to over $440 million in the multifamily, senior assisted living, and hospitality arenas. He is passionate about helping others achieve financial freedom and giving back to our seniors who have given us so much. So with that said, Vinny, I'm going to turn it over to you. And now if you want to take the slide, just remember everyone, type in your question.
So much. Thank you so much, everybody joining. I appreciate your time, and thank you, Alex, for a wonderful introduction. You know, we just did 40th wedding anniversary right here in the Bay Area in San Francisco. If any of you are watching us and listening to us later on, please do reach out to us. We live right here in Blackhawk, Danville, and Monil Senior Living is my new part of the company, which is Monil Investment Group. Actually has been buying multifamily apartments. I started from 14 units, 14 units, and now we are able to, again, disclaimer, you know, just like Alex read, that this information presented is believed to be accurate, and information document not represent any offer at all. And, you know, please do get your CPA and other, you know, attorneys advice, you know, into the matter. So let's go to the next one here. What do we have? Oh, there we go. That's me a little bit here. I think you already covered it. I apologize. Now I can feel my touch there. It's already there. You just went over that, Alex. I appreciate that. I did sell books door to door, by the way, knocking on doors outside Atlanta, Pulaski, Virginia, things like that, when I was going for my MBA at George Washington University, and cut my teeth into sales career and changed from a mechanical engineer to a sales consultant and motivational speaker and things like that. So that's, we already have seen that. Our partner also in the senior living space, which we'll talk about it a lot, and you will see why, because it's just a demographic shift is happening in USA. 10,000 baby boomers are turning 65 every single day in USA and across the world also. So our partner Shahid Imran, he came also at a young age at 17, with zero money almost, from Pakistan, and then we united here, in USA, with the land of opportunity. And he's been in the health science field and also building senior assisted livings for the last 9 years, and have built over 23 successful communities over 400 million. So that's a pretty nice one. And the motto is, we want to spoil the generation that has spoiled us. And then, of course, I want to share, John Rooston, who also went to school with Shahid, actually. That's how I came to know John. And he's my vice president of the academy, where I teach also. And we have courses online to learn how to look into deals, how to really underwrite, how to talk to brokers, all those things like that. And we are writing a book also together. And just to say, again, you might have seen me on some podcasts. I've been on over 200 podcasts now, all over the country, all different ones. So if you get a chance, please. Also, then, Alex mentioned my book, The Apartment Syndication Made Easy, really been well viewed all over across the world. Over 400 reviews now, positive 4.5 to 5% reviews. So if you would like to get it, and it's in Spanish also, English and Spanish, if you like to take a look at. These are the other book that I wrote, Positivity Brings Profitability. And our third book is coming soon, which is on senior living right there. And then, of course, on the podcast, like Alex said, again, I just wanted to share that with you so that you can see what I'm speaking is from some kind of knowledge about the subject. That's the main reason we are kind of going over this. You could even scan it if you would like to listen, or you could go to iTunes or Stitcher, and you could listen to all the podcasts. We are in YouTube also, and the books are also on on Kindle. No, Kindle is there. Audio, sorry. Both the books are on audio also. Alrighty, let's talk about, this is the main thing. Why syndication, which is the best thing. See, the syndication world is a very, very nice world where we can pool money together, so small money from different investors, so that we could purchase any kind of commercial buildings. Could be senior assisted, could be apartments, could be the mobile home parks, or storage spaces, or hotels, or whatever like that. We usually delve ourselves into the 506B, and then 506C is the one where you can accredited investors only, and also it has to be verifiable accredited investors, and we can advertise. Actually, we are putting a $50 million fund as we speak right now, which will be in the 506C. I do want to take a couple of minutes here, thank Advanta, because they have been our partners for a few years now, and we have so many happy customers, clients, our investors who have gone through Advanta, and they are so on top of things, and their costs, or doing the business with them is so minimum, which is another part why investors love, working with Advanta. They are very, very professional. I just want to say there is $31 trillion of retirement funds in USA. And as you know, in the real estate, self-directed IRAs and 401ks and all these different retirement funds, you could invest in real estate. So it's a great, great opportunity to get out of the Wall Street, put it into with Advanta, so that they could have you checkbook control, we call it, right there. So let's go here a little bit more. Oh, wow, what happened here? hmm, hmm, hmm. Can you see me out? It says,
Yeah, you should be able to move your mouse.
oh, okay. I'm just trying to say, it just took me connected to, uh, oh my gosh, what happened here? Launch. Uh, I've been logged out, it says. Holy
Oh no,
cow.
we can still hear you.
Oh, you can hear me, but I cannot see uh, the screen anyway. Wow.
Let's see. Yeah, it's still showing you there.
Okay, yeah.
Try to advance the slide real quick.
Okay, I cannot see the slides anymore. That's interesting. Hmm. I don't know
It
if.
might be down on your taskbar. If you look down, you should probably have it looks a little bit like
Let me.
a lotus
Yeah.
blossom.
Oh, okay. There we go. There we go. Go to meetings. Yeah, there we go. Yeah,
All right,
I
great.
can now. I can see it now. Thank you.
Awesome.
Let's just go here. Next one. Okay, sorry about that. So again, we have accredited investors, sophisticated investors. As you know, many of you listening to us or watching us might already know accredited investors are the ones that have 1 million net worth, not including your primary residence equity, or making 200,000 in the single person in the household, or 300,000 annual income in the last 2 years. And then sophisticated investors on the right side are the financial knowledge, who have the financial knowledge to understand risks that come from any kind of putting together investments. They have gone to some seminars, they have experience, they have you know uh, uh, bought stocks and things like that. So there is a special language. So there can be accredited investors or sophisticated. In our company, we take both, and I'm sure Advanta also can help both of these kind of investors. So that's very, very good. I again, why we are so excited about assisted living. Let's go to that one, which is this one. This is a beautiful slide. Everybody, please look over here. We are in the 2021 January, and let's just say by December we were estimating to have 56 million people 65 plus in USA. We have 340 million or something. That's a pretty big chunk, as you know. And then 6.7 million are in the 85 plus range. And as in 10 years, that 56 is going to grow to 74. And then 74 is going to grow 82 million. And then in about 2060, that's about 40 years, not that far away, 100 million people are going to be in the 65 seniors. And then similarly 85 plus is going to increase also to 20 million. 20 million. Oh my gosh, that's mind boggling. So that's where we are very excited about senior living. It could be all kinds of senior living, by the way. If and again, the deck is available to you all, which is great. Please look at it again. The key thing is, see over here, we are in the 2020, 21, right about there, where because of COVID also, it hasn't helped much, but it's coming back with a roaring speed in 2021. You'll see a lot more permits given, lot more building permits and all that for senior housing. But even if we get on a big growth, we are going to have such a supply shortage for the next 30 years. Look at that. That's 2050 right there, right? So there is a huge demand for the senior living market. And that's where we are, trying to get ourselves into it. I'll take this one. Many of you all watching might be in commercial space already, but if you're not, let's just think about it. Even apartments, which is the best of the best category, that has given very good returns to investors. As you can tell, this graph, we could only get it up to quarter 2018. That's what couple of years old, but it's been even on a big crescendo from there onward also. 19, 20, of course, COVID year. But look at stabilized senior housing. Wow. That's like almost double the returns, almost double the returns. And even the gap is getting bigger and bigger, as we are saying. And that is really the truth. Actually, we have found it in the communities that we are managing right now. We have built them and so forth. That's what we are seeing also. That's a very good graph also. We wanted to show you senior housing market trends in the downfall, economic downturn or meltdown of 2007 and 8 and 9. look at that. The senior housing, that's the green one, it didn't even go down at all. It was just about even. It went down in 2019, just a tad, very little, maybe like 1% negative. But even the apartments took a big dip. Look at this one, the line. That is the one which shows, of course, the dip of, say 2008 and 9, right there, big dip. Of course, hospitality went way down, office went way down, things like that. So we also saw, even during COVID, once we put this over here in the 2019 and 20, we'll still see that the COVID had zero effect actually on the senior living, because they had to be locked down. I know we did see COVID deaths in the nursing homes, which is not what we operate in, but that was because of seniors being contagious, and somebody brought it from the hospital, coronavirus, and then they just couldn't control that. And we have, I think, one slide or two about that. Again, it's a $1 trillion industry. Trillion. Oh my gosh, look at all these. This is 4 trillion, 5 trillion, 6 trillion. So all these numbers are real projected numbers. What is going to happen in the national health expenditures? And these are in billions. So that's why we said 4, 5, 6 trillion. And it's going to keep on growing as the population gets, more and more and more. More facilities need to be built, more money needs to be spent, more medicines, more equipment, everything. So there is a huge demand, for what we are doing. Let's just kind of look at it a little bit as you are watching. What are we talking about? Our partial portfolio is just shown like we just built this senior assisted living, beautiful 7 acres of land, 3 courtyards. We'll show you some pictures of the Cape Coral, Florida, opened already. We should say opened in June or July. Actually, we opened in July 2020. Then the COVID, during COVID, as you know, and we built it for only, we should say built up, 12.3, and then we got an offer at that time. We didn't sell it from a REIT, actually wanted to pay us 19 million, and make a good gain of that, but we didn't sell it. But this one we did sell, as you see, April of 2019, we sold it for 13 million. This one we built for 58 units only, February, and sold it for this. And then there are other ones that we are also building. As you can see, oh boy, that's our Monil portfolio. There we go, Hampton Manor. Because Shahid lives in Michigan, he kept on building every city in Michigan. As you can see, Hampton Manor is our brand. If you could just Google it, in Michigan, you'll come across all these beautiful places that are being built and so on. Now we are building in Florida, in Virginia, in Texas, Arizona, and Mississippi, Missouri, all different places. Now we have joined hands, as you know, ourselves, myself is Monil Investment Group, Monil Senior Living, with Shahid's company, Build Senior Living. And this is the one we just purchased from my side, 34,750,000 in Austin, just in September 16th, right there. Then we bought Bentley, $52 million deal right there, 324 in Florida. And then we bought Princeton Park, also 35 million. So we've been buying 29 of these kind of things, just to kind of let you know. I've been doing it for 14 years, and that's where my experience comes from. Not only buying them, being on the loan on all 34 syndications. I'm the principal on the loan, maybe with one or more person in few deals. Rest of them have been totally, I'm the GP and on the loan, key principal, we call it right there. Then REIT performance also is roaring back. It's just amazing. After COVID, rebounding is 73%, data lows. So it's going to be huge market, and please look through the PowerPoint deck, as you get it. We do want to talk about it because nobody can do anything unless we talk about COVID. As you know, vaccination is getting done now. Our facilities are already being vaccinated, all the seniors that we are, managing communities right now that we build ourselves. We don't really take any already built communities and then change them. We don't do that. We are not in that business. We want to build luxury senior assisted living, one story, no elevators, and with 4 to 6 courtyards, because we want our seniors to go out in the garden and go out outside, go to the swimming pool, go to putting green, and just have a healthy life, and so that they can really, really enjoy. That's why we build it from scratch. And then again, senior living housing, we won't go into that. Cap rates, that's when you're buying. This is a very good slide we put together. And as you see, choice driven senior living is age restricted apartments, no regulation whatsoever, no services needed. Independent living is also housekeeping probably needed, transportation, but that's also very less, choice. It's all choice driven. But increase acuity, we are in the middle space, in the circle, which is assisted living and memory care. We feel that's the spot where we want to be for the next 40 years, because that's where we don't need any doctors, no equipment in our multifamilies units, and it's one nurse present only for 60 to 80 to 90 residents. And then the last one is the more skilled nursing, more like the nursing homes, rehab centers. That's where majority of the deaths have come in corona, right there on the right side, which is need driven. They got a lot of equipments, a lot of medicines, doctors in and out, and a lot of patients coming in and out daily. All that's we're more susceptible to the deaths, right there. So we are in the sweet spot, in the middle. And then we also did one more. This is a very good graph, I mean the table we put together also to share with our audiences. As if you are investing in multifamily, like already built multifamily in the C class, as you know, B or B plus classes. That's what we've been chasing all these last 14 years, for jobs, 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 going from Texas to Atlanta, Georgia, to Florida, and back to Texas. And now we're looking into different other places in Tennessee and all that. But the good thing is, these are already built. The lower is the income potential, because we might charge like 995, 1295. In Florida we are charging 1395. But the higher number here is because of A plus facility. First of all, brand new built with lots of great amenities in it. We have like the movie theater, we have salons, and the 5-star dining, cook to order, dining 3 meals a day, all those things. Even though expenses are higher, but this 1300 compares to 4400 here per month. So 4400 is almost 4 times, 3 to 4 times, 3.5 to 4 times revenues. So it's a lot of revenue in the newly built assisted living or residential even. But then concessions are zero, and it's low to medium on this side. Delinquency is zero, because everybody pays up on the first, because the money is coming from their reverse mortgage of the home, or it's coming from their revocable trust, or it's coming from long-term care. So all these private or children, they're paying portion also. So we have almost zero delinquency every month, which is a low over here. Now, this is the biggest factor, demographics. See, we've been chasing working class jobs, 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 jobs. Where will the people be having job to pay for the rent? And if the job changes and they lose job, like in COVID, what happened? How the delinquencies went higher and higher in C class and B minus class. But this one is non-working resident. That is the beauty of the assisted living, is that these are our 75, 80 years, 85 years, or 90 years, or 100 years resident. They have already made it. They have, now they need help and live the kind of golden years in dignity and respect. So that's what we are really into, the business of making great communities to show our seniors how they can live comfortably in a mid-range. We don't charge 12,000 or 10,000 per month. We are not charging, and because we build for a very, very low price, good price, because we build ourselves, and then we keep our prices low, anywhere from 4,400 to 5,500 per month. That includes everything and everything. Average stays 24 months to 30 months actually in our communities that we have built and we are managing. It's only 6 to 12 months, 13 months, but you do renew it. But there is a element of people not staying there. Then maintenance is zero because we just built it brand new air conditioning, brand new roof, brand new parking lot, brand new boilers, you name it, everything is brand new. So deferred maintenance is low to high here, but it's zero here. Zero. Deferred maintenance zero, and maintenance zero, just like I said, can be a lot. So these are lots of places where the money leaks out, in multifamily. At this time, it's very, very hard to make even 7% cash on cash in some deals, by the way. I mean, unless you're buying a value add deal, smaller size. But if you're in the 150 to 200 range, 300 range, it's hard to get even cash and cash flow, cash on cash of 6% even, and the cap rate is 4%, something like that. But then turnover is low, very low here. It's medium to high here. And then investment hold time is 2 to 3 in our build up. Like we are doing the build up, we hold the money from the investors only for 2 to 3 years in our deal. But as compared to, I've done these also, and I just did it, in September of last year, right? So it's 5 to 7 year hold here because it's tied to the jobs, tied to the companies growing and everything. We can't just buy something and sell something very quickly. We can't really do that. In this case, we can. Once we stabilize in the third year, we could sell it to REIT or fund or even buy ourselves, and the IRRs are strong, 16 to 19% IRRs as compared to with the today's market. It's very tough to get 9 to 15% IRRs in the already built, multifamily. So I just wanted to take a little bit more time, but let's ask some, questions. Anybody has any questions?
So yeah, I just wanted to kind of wait till we got to a good breaking point. We do have a good question here. So how would you compare the lease up period between a Class A assisted living facility and a Class A multifamily apartment?
Excellent. Very good point. Very good point. I would say that assisted living class A, it's need driven. Multifamily A plus or whatever new construction is not, it's need driven, but at the same token, you're competing with lots and lots of new product over there. Possibly you're also dealing with the B class, B plus class, and so on. And there is a limited pool of working class that can afford A plus already built multifamily. In this assisted living, we do our capture rate surveys in the neighborhood. How many assisted living are there already? We know that. And how many are being built? We know that. We do the projection. What's the capture rate? So when we are only 60% built, 60% to 70% built, our assisted living, we hire the executive director, leasing agents, we start doing promotion, advertising in media, in televisions, in print, and websites are up. So we are almost 50% occupied. Listen to it. By the time we open the door in assisted living, and we are 95% occupied within 9 months. Within 9 months. So that's the difference. That's the difference.
That's
One is
quite.
very much need driven. One is choice driven.
And then before we just have one more question. We can get into the tax benefits, which is kind of where I I really start to enjoy this stuff. We have a question. What is IRR, or individual rate of return, and how is it calculated?
Excellent. IRR is internal rate of return. That's the abbreviation for that. It's the time value of money. Other words, if you're getting your money back quicker from the investment, like if you put 100,000 today and you get your 100,000 after 10 years, so you didn't get your initial investment back until 10 years, and then you kept on getting cash flow, cash flow, cash flow, and then equity gain in 10 years, then your IRR will be less. But if your money is churning, we call it velocity of money. What that means is that you got your money back in 3 years. Now you reinvested it again. Holy cow. So now you're getting an IRR of whatever I just shared with you, 16 to 19% in 3 years. Then you put it again for 3 more years. Now you get 16 to 19 again per year. So that's where it is. It's a time value of money. It's internal rate of return. It's a good way to compare investments. Yeah.
Awesome.
All right. Okay. Cost segregation, I would love to mention that. And all our passive, active investors, everybody, doctors, attorneys. I mean, we have a big database of our, already vetted, investors, right? Who have been dealing with us for 14 years. And they love cost segregation because what it does, cost segregation or accelerated depreciation. We could do straight line depreciation on residential like apartment buildings and all. On 27.5 years, we take the total purchase price minus the land. Land does not depreciate at all. So the rest of the amount we divide it by 27.5. It's a straight line depreciation. But tax law shares with us that lots of parts of the building could be, the knobs and the cabinets and the flooring, appliances, roofs. They all have different amortization schedule, we call it, and that's what it is. So we have 5 year, we could write off so many millions of dollars. In 7 years so much, 15 years so much, and 27.5 years so much. So we are able to accelerate depreciation, which is a paper loss. Depreciation is not a real loss. The LLC, the senior assisted living, might be making ton of money, but by doing the taxes in the LLC, which is a pass-through entity, we put the cost segregation minus of 21% almost of the purchase price. We just got the cost study done recently. Our investors, in my other one too, 100,000 investor got minus $61,000. Wow, passive loss. And then they can combine their other passive incomes and everything. If they are real estate professional, I'm not a CPA, you could combine active and passive losses. And that's why a lot of time people pay zero taxes, right? You could make a lot of money but pay zero tax. So that's a very good thing. And self-directed retirement plans, that's where Advanta comes in, and we are so proud to work with them. Would you like to share some things, Alex, over here, buddy? Yeah.
I mean, absolutely. I mean, it's one of those things where there's a lot of different ways that we can go with kind of getting into the tax benefit of this, but without getting too far off the line of what we're focusing on with multifamily, the big benefit is that really where it comes into multifamily is not so much of the tax strategy of the ultimate LLC. It's the fact that if you're looking to invest in some type of syndication, whether it be a multifamily, whether it be a assisted living, or really any type of class of syndicated real estate deal, the fact that you can use more than just your personal taxable money, which is very specific to the things that we're going over here with cost segregation analysis and accelerated versus natural depreciation of assets, is the fact that you can take your tax deferred or tax free money, if it's in a Roth or traditional or even a solo 401k, and use it to invest in one of these deals without having to take the tax penalty of taking it out of that tax shelter. So that's the huge benefit to utilizing this, is that you can now base a portion of your retirement on the actual multifamily deals that you might be doing otherwise outside of this. So that's why we like to bring on people and experts such as Vinney to kind of illustrate more of the details of what it means to go into one of these deals specifically. And then we like to come around and the backside and say, hey, you can also use your IRA to do these types of deals, to use more of your money than just the taxable stuff that you have sitting around. So that's kind of what I'll leave it at that, and then I'll turn it back over to
Sure.
Vinny for the rest of the
No,
presentation.
thank you. Thank you, Alex. I just wanted to share also the movie theater, like we put it in every community. We have spas, we have hair salons, we have game rooms, we have sunrooms, we have library. I mean, and the dining is exceptional in all our facilities, sous chefs, junior chefs, and they ask the residents every morning when they come for breakfast, cook to order, what would they like for lunch? And at lunch, we ask them from the menu what they would like to eat for dinner. So they choose their own, and they can even bring their own recipes. Many seniors do, and our chefs cook for them. So that's all included in that $4,400 or 5,000, 3 meals, snacks, all the caregiving is all including the nurse time and everything, of course transportation, daily living, exercises, everything is all included except the cell phone. That's all. Rest is all facilities they can use without paying any penny. And then we build, the billiard rooms and the lounges, and then grand piano, even have entertainment from outside come for the residents. We usually build about 88 units to 92 units because we don't want it to be too huge. We like to take 5 to 7 acres of land at least, so that we can build some very lavish one story, the whole thing with 4 to 6 courtyards, like I mentioned it. Like this is our transportation. We own ourselves. Hampton Manor is our, if you Google us, Hampton Manor, you'll come across lots of great, places we are building, now all across America. Lounges, dinings, private dinings. The residents can bring their family, their children, their grandchildren, and celebrate birthdays, by itself. Of course, COVID, we are very, very cutting edge. We have plexiglass studios where our seniors can be on one side and their family can be on the other side, because a lot of other senior assisted livings people cannot see their family because of COVID, contraction and things like. So we did it in Florida, in Michigan, and with plexiglass studios and all that. So that was very nicely taken. And then you could see the quality, the designs, everything. We build it like right from scratch, furnish it, the color combinations, everything. And then the big thing is that are these courtyards. That's what we want them to really be outside in a good weather, and just be, some of these beds are also to plant trees, I mean vegetables and flowers, so that some of the seniors love to really have all those. And then swing pool, of course, they'll have the caregiver, with them and everything. Then the putting green on the right side, that's our memory care division. So we always build independent and assisted living to the right side, 2 3 compounds. And then the right side is actually, right there connected with the building, and that's where we do our the memory care goes in there. So that's, again, I would love our audience who's watching us right now or even later on as get a free report on senior housing. All you have to do is just go to seniorlivinginvestingmadeeasy.com, which is also the title of our book, by the way, Senior Living Investing Made Easy. We are putting lots and lots of great information for all the people to educate. That's our mission, is to just educate, educate, educate our baby boomers, our millennials, because they are the ones who are making decisions for their parents. And then also our seniors to not only invest into with us in different deals, but also live into our premier, communities. You could just scan right there to get a free report, if anybody would like to do that, or just put your name and email and you can download the report right there. And I would love to also say, interested in passively investing in great assets, like the multifamily. Oh, this is the senior living, how we build it, by the way, right in the middle. Or, we'll be buying name brand hotels. We just bought Hilton Garden Inn. We'll be buying Courtyard Marriott's, Comfort Inns, things like that, and stabilized assisted living. That's the ones that we have already built, and now we are buying them. instead of selling to REITs, we are buying. So these are our four different businesses, along with our another business, which is big one right here, interested in learning how to buy apartments, how to really, underwrite and talk to brokers, and which markets are best and which are not. We teach you everything from ground up through online training, and also weekly mastermind inner circle, we have right here also. So please, scan this here and reach out to us for a free strategy call. You could just go to vinneychopra.com at academy. And thank you so much, Alex. And I would love to answer every single question there might be.
Sure. So there's actually a couple questions on here that the last two I think are kind of directed at me, so I'll answer those. And then I have some
Okay.
more questions for you, specific to some of the stuff with regards to strategy as well. So because self-directed IRAs are tax deferred or tax exempt, what would be the reason to invest in syndication with retirement funds? What
Very
would be
good
the
point.
expected return on investment, time frame, et cetera? And then
No,
to
very,
follow that up, as we covered, the
yes,
self-directed IRA would not receive any tax benefit of
they
depreciation.
will not. No,
Yeah.
right,
So
right.
Calvin, you are correct insofar as that they don't get to necessarily take advantage of that, but the advantage of using an IRA in this scenario is a little bit more um, high level, if you will, than just the immediate tax benefit of being able to take accelerated depreciation, cost eggs, and things like that. You get to use more of your capital to diversify your investments by doing things like investing in multifamily. The service that we mainly offer, clients that are using their IRAs for this is that they're looking for a diversity vehicle. They have, people that have done doing multifamily deals with their IRAs typically aren't taking their entire retirement and basing it directly in one asset class. And most people don't do that as well. I can't advise anyone on their investment strategy,
No.
but diversity is generally seen as a good thing. And what they use this for is a diversity vehicle to say, hey, I'm going to take a portion of my retirement and invest it in something that, I either know intimately well and understand, like the returns of, or like the security of, from the aspect of that it is a tangible asset. So that's mainly the reason that people will utilize IRAs for this asset class. Now, there are other parts of real estate investing that we do as a company that offer, a significant tax benefit. Things like flipping houses or doing short-term transactional lending that offer a much bigger, directly perceived tax benefit than maybe investing in a syndication.
Totally, totally.
Now we have
And
a great
I would
question.
say, I will just add that, Roth IRAs, I know a lot of people, as you know, once you pay tax, then you never pay tax again. So those are the other ones. Roth IRAs are amazing because you can multiply, multiply, multiply in your retirement, never have to pay tax when you withdraw.
Absolutely, that's an awesome one. Now, Pam asks, "What are your and this is directed towards you, Vinny. What are your thoughts on repurposing existing commercial properties such as retail, office, shopping malls, and plazas into senior or multifamily spaces?"
Totally, totally. I mean, we don't do it, but definitely there are different ways to do it, especially with the COVID and what's happening right now. Repurposing is very much in fashion. You have to look at all the rules and regulations and guidelines from the local communities, local, authorities of the building permit departments to find out what you need to do. A lot of things depend on, how big these structures are they small, and how you're going to be, how much money it's going to, would you have to just level them off? That's why we don't really get into anything like that. We just buy brand new land and we build it within 12 months. Sometimes we build the whole structure, everything in 9 months, by the way. So we are able to do that. But no, repurposing is amazing way to do that. Even hotels are being converted into apartments, workforce housing, and then of course senior living has more implications, because of the size of the doors and all the bathrooms. Like if you saw some of the bathrooms that we make, it's amazing because you have to have wheelchairs. You don't know who's going to live in that unit, so you have to have all those things taken care of, so that the bathrooms are huge, especially if you are buying or repurposing it. You may have to take the bathroom which is there already plus another portion of the room to make that conducive, huh? Yeah, yeah.
Yeah, great point. That's definitely an interesting question that I really wanted the answer to as well. Now, here's one that I kind of, coming from me personally, that I have a question for you on, Vinny,
Yeah.
is that when you look at the type of senior housing that you are
Mhm.
going after, like that you're building or that you maybe were looking to acquire, the A plus uh, style units, what do you think the perceived, like let's say you were to build an A plus versus an A or maybe a B plus, what do you think the difference in the rate of rent up or the occupancy, the push to getting occupancy to 100%, what do you think the big driver is? Do you think there is a benefit in speed to getting one fully occupied versus doing one versus the other? Is the marketplace trending one way or the other in your mind, towards which type of units, there's more desire to have being built?
Very good point. Very good point. I don't want to say all of them. Lots and lots of the senior assisted living space, as we have been, touring them, let's say. Also looking at some of the statistics, 17% are 25 years and older, and about 35% are, very, very old, right? Some of them
Uh-huh.
are dusty and smelly and things like that. So it's not that, they are not, but sometimes money has not been spent to, make them really, really nice facilities. When we build A plus like this one for a very, very small cost, we find lots of seniors and, their children are always looking around, right? They're looking what's in the community. Where can my mom or dad have for the same price or $100 more, get a better living quarters, living place, and also much finer dining and have all the amenities. So that's where we spoil the generation, and we find that our occupancy goes up higher right away as people are giving notices from the existing, and then they have to then do more advertising to get more seniors into their facilities. But then they do compare the market. We are not that high up there. We charge about the same price. Can you believe what old and old facilities charge in the same community? So that has helped us a lot. Our model is such, it looks very, very nice, and it looks very nice A class, but we don't pay that high price because we have done it and perfected the system.
Great point. That's something I never really would have thought about, is the diversity of where these things are marketed to, which can actually, instead of being a hindrance, might actually be a benefit to that. Now we have a question from someone, and excuse me, Jonathan, if you're hearing this, if you could maybe elaborate on the acronyms you're using. How could you go about starting an ALF, which I'm assuming you're meaning assisted living facility, and my grandmother's SFH, which typically means single family home?
Oh,
Um,
single family housing, I think, right? Single family housing, and then residential assisted living is the other one, ALF. So what it is that there is like up to 10 units or so. If there is a big house with 10 bedrooms, for example, some people are in that business, and rightly so, because there are lots and lots of different bigger homes that can be converted into. We are not in that business. We are just looking for the next, I would say, 10 years to build about $2 billion, be the B, $2 billion assisted senior living luxury, just like this one. And we'll go all over United States and in small, small towns, wherever people are migrating, where seniors are migrating into warmer states. That's where we'll be building these. But there is a big market for the residential, ALF, we call assisted living facilities, you could say, or assisted senior living, facilities right there. Of course, independent senior living, if the question was if my mom has a house, if they could convert that, if she has the money or children have the money, and they can have independent caregiver coming there If he needs 24-hour of assistance, then that'll be, and you all can afford it. That's amazing. That's the best way to live, is by yourself in the community you have been living in, with the help of caregiver, and maybe a nurse can visit and they can pay for that. And if they can, even, I don't know about the meal, how will that work? Assisted living facility like ours, when there is a slip or fall and the seniors, mom or dad, cannot cook, first of all, or there is a death of one of the spouses, then the life starts degrading, because there is the element of social element dies off. That's where we find that the children sit down with their mom or dad or both and say, you cannot cook, you can't take care of yourself, and we would love to have you stay at an assisted living. Then they start looking around nearby, where they want to live near to the children, or they want to live where they are living right now, what's available. That's where we come into the play, and they look at our facilities and so on.
Yeah, great point. And I would encourage people. We're still getting questions coming in, and I'm letting Vinny get all of his information out there. So stick around. I do see your questions are kind of filtering in. I'm just going in order that they are asked. So the next question that we have coming up here, and this is actually one I'm very curious to know the answer on yours end as well, is that David asks, what is the difference between assisted and independent living, and are there any expense differences between the two?
Very good point. Very good point. In our communities, we take independent living spouse if other spouse needs assisted living or memory care. Alzheimer they have, but one is independent, the other person, is Alzheimer or memory care. That's where we will take them. But you're right. Independent living, if both the spouses are independent living, we don't take them because we need to have room for assisted living. There is such a high demand. I mean, even in the communities where we build, Alex, we build a capture rate. If we need a demand of like 1,000 units, right, in a community, we build only 10% of that, because we know other people will also be building. So because it takes about a year to build, and then it takes about 7 to 8 months to get the permits before the build. So we are a 2 year span at least from the day to day. If we say we want to build a community in one place, it's going to take us 2 years to open the doors, right? So that's why we put thousands and thousands of dollars in the feasibility study. And that's very important, because they look through demographics, they look at comparable, what's out there, and they give us a 70, 80 page long, report, which pay thousands of dollars. Then we lock in the land, 7 acres of land, on a 6 month closing. You have to,
Oh man.
because you have to change the ordinances and everything. If the land, we don't get the permits, then that land is worth zero to us. So then we get out of the contract, right?
Gotcha. Yeah, here's a good question from Pam. And the central point of this question is, how do you choose a market? And
Very
then specifically, if an area is well known for retirement areas, or already has a substantial amount of senior assisted living, do you take the average income of the area into account? And how do you kind of choose that? I know it's kind of like that here in Florida where we live. I live in Pinellas County in St. Pete, and people have been retiring to Florida for decades.
Yes.
So it's a very saturated market. What are things that you look at when you look at more saturated markets that help you
Very good,
determine
very good
like
point. Good question. Very good question. Exactly. We try to see demographical shifts. We look at a lot of data points, and we see where seniors are migrating. I know in Florida, it's been just tremendous. We just built that Cape Coral. All the pictures you saw today in the webinar are from Cape Coral facility, which we are very, very proud of. We already started to build in Punta Gorda right now, and within a month and a half we are into framing. Hold on, we are so fast. We had 68 workers working daily, at that facility right there in Punta Gorda. And now we are starting other places in Williamsburg, on the other side of the bay, on the coast near Kennedy Space Center. We got land we bought. We're going to be starting. We are going into Texas. So what you're right is correct. Our study that we pay thousands of dollars, they look at the buying power, they look at the net worths, they look at the occupancies for the last 10 years in the assisted living. That's what we pay money for them, right? And they do the interviews, they find out, they give us on a silver platter the whole feasibility study, and they tell us what should be the amount we should be charging for 1 bedroom, for studio, for 2 bedroom, and this is where it's going to go in the next 5 to 10 years. So all those things are very important before we put our millions into it. So if it's oversaturated, maybe that's not the right place. But maybe because people are still coming in through the data points, we will do a whole feasibility study and find out maybe there is more room for
Sure.
assisted living like ours, which is a much different product than 2-story, 3-story, 4-story, 5-story buildings, and with 282 square feet of the space for the seniors, ours are 483, doubled,
Sure.
so that way. Yeah, yeah.
Yeah, that
And
makes
that's
sense. There's a lot of different factors that go
one
into
bedroom, two
whether or not
bedroom
it'd be a
building.
good market.
Yep, yep. Hmm.
All right, so we got David asked, what were some of the biggest steps that y'all took for mitigating COVID-19 and the issues that you saw from other places, and how you managed to have, I think you said, zero fatalities in your
Yes.
businesses. Please correct me if I'm wrong
Yes.
on that, but I believe you said that.
No, I would love to expand on it. See, we are very, very great operators of our facilities. We have executive directors. We've been doing it for 9 years. So we have perfected the system. We have one walk-in right from the entrance. If I don't know if you could show that again in the back, the entrance is one, only one, and then we have one on the memory care side also. So two balcony, two nice places to enter in. We were able to lock down, 100% lockdown, even before the governors or mayors said of the city. And then we kept it locked down, didn't let even the children to meet their parents, even though they wanted to. They had to see it through the windows, celebrate birthdays through the windows. We did walkie talkies, we did video, FaceTimes, computers, all that. And that is the secret of our managing. We had zero COVID death, zero coronavirus, and we are very healthy, all facilities. But then we came up with the cutting edge, like the one plexiglass rooms. We were in the news in Florida, by the way, at the governor's office, and they were saying, "Oh my gosh, look at Hampton Manor. They're able to have their parents, and the children had to show 14 days of negative effect reports on every family member who would come sit on the other side of the plexiglass." We have studios, all contained, studios in every one of our facility on the right side, where we built it for 2 bedroom kind of thing. So now we have been able to do it, duplicate it, where the air is, where the parents come and they talk nicely and they see each other. And we have seen people crying because they couldn't see their parents for so long, face to face. And that's where we are able to do that. So answering your question in a long about way, we are very, very cognizant of the CDC rules, our temperature controls with our caregivers, and making sure that we train our caregivers 6 weeks. 6 weeks they have to get certified, our own training, before we even place them at our facilities. So we are very, very strict, because we want to make sure that our seniors are safe, they're healthy, and they are really enjoying the life, their golden years, we call them, right?
Yeah, absolutely. That's some fantastic answers, and that's definitely something to definitely be proud of. Any with everything going on, that y'all have managed to do that. It's been tough for all of us. I have an older parents and grandparents. So it's been a struggle for our families to navigate this as well. But that's quite impressive that that's managed to occur. So what I would like to say to everyone, though, is that we're getting kind of right up on the end of this. So if you do have any questions that you'd like to ask Vinney or get in touch with him, his information is up here on the screen right here. And also, all of the slides are in PDF format for anyone that wants to download them. So if you want to kind of peruse them at your leisure, they are attached in PDF format. Please feel free to download those. They're right there on this portal here. Or you can always wait till the YouTube video is posted here coming up. But we have one more question from David, and then we'll kind of wind this in for a landing to make sure everyone's time's respected for the hour that you scheduled for this. And this has to do with determining costs, and obviously, Vinney, go into as much detail as you feel appropriate for this. But it goes into what can you charge per person on shared home independent living expenses, and what minimum rooms are needed for optimum returns? And I'm assuming that varies widely from demographic to location and correct?
That is true. That is true. Majority of our senior assisted livings, we are not building luxury like 10,000 per month. There are. If I bring the same buildings over here where I live near Danville, Blackhawk, I mean, my seniors will pay me $12,000 per month, literally. I've shown it to my builder friends, I've shown it to other people, but we build it in the communities where medium age is about, I mean, average, what's that? Earning power, we say 47,000 to 50,000. So it's not that high. And that's where we also look at our cost is anywhere from 4,800 to 5,500. That's all we want to do in that range. Of course, if they need more acute care, not acute, but level of service, right? Level 1, level 2, level 3, there might be another $300 added to it or 400 added to it. But we usually cater right in the 44 to 4,600 to 5,500.
Awesome. Well, thank you very much. I really appreciate you being on here today, Vinney. It's wonderful to have experts like
Thank you,
you.
Alex. Such a pleasure, and thank you everybody listening and watching us even later on through the webinar. Yeah. Huh? Sure.
Yeah. And again, very much, it's awesome to have experts like you on here. If you have any questions for us, my contact information is up here just to make sure it appears on the YouTube as well. If anyone has any questions for Vinney, I can't stress enough. Take advantage of the fact that you have, that you have the contact with these kind of people. They're wonderful to continue to learn from. And with that said, we'll get everyone out of here, and the recording will be posted up sometime tomorrow on our YouTube channel. So again, thank you everyone for attending today. It's been another great one of our educational series of webinars at Advanta IRA. And Vinney, again, thank you very much for your time this afternoon. We really appreciate
it. Alex, thank you for arranging that. Really appreciate you guys. I mean, Advanta is really great company. I will highly recommend everybody listening and watching us to reach out to Alex. Wonderful.
Thank you very much, Vinney. Everyone have a great rest of your day, and Vinney, you as well.
Okay, thank you. Bye-bye. Bye-bye.